Again, I want to welcome you all to the Business Capital and Exit Strategy. I'm excited to announce these panels because I'm very honored to be working with a lot of them. My name, as an introduction, I'm Brian Sparks. I'm head of communication, no relation. Head of communication for Bay Angels. I'm also an executive communication coach out of Silicon Valley. So without further ado, I would like to introduce our first panel. Our first panel is going to be Raising Startup Capital. First up, I'd like to introduce Sean Flynn. Sean Flynn is an investment banker with mergers and acquisitions and growth capital. He's also the head of the Silicon Valley podcast and a great connector. Sean? Our next panelist is Roger King. Roger King is the founder and CEO of Bay Angels. Again, another huge connector in the space and is somebody you need to know if you're getting to launch your business. Roger? All right. Finally, I'd like to introduce Sam Wong. Sam Wong is the CEO of Fundable Startups and Venture Validator, one of the smartest people and most insightful individuals I know. So if you have any questions about all the chess pieces on the board of startup, this is your man to talk to, Sam Wong. And your moderator for this panel is Wen Zhang. Come on up, Wen. Wen is the CEO of If Not Now, When. She's also the CEO of an accelerator here in Austin. I'll turn it over to you, Wen. Thank you.
Thank you, Brian. Good morning, everybody. Wow, happy Friday. What an amazing way to start a beautiful day, isn't it? We are so excited for each and every one of you to be here today. And if we have not met, my name is Wen, just like If Not Now, When. Today, I'm the founder and CEO of INNW Institute, a global accelerator. Today, we are so passionate about helping entrepreneurs from all over the world tell the right story to get yes. Yes from investor, yes from customers. Because we believe that raising capital is the number one skill set for entrepreneurs from any growth stage. And that's why I personally am so excited for today, the first panel, speaking with us all the superstars here, talking about raising capital for your startup. So with that, I'm gonna kick off the first question. I would love our panelists go around to share about yourself, your experiences, and most importantly, your path in raising capital.
I'm Sam Wong. I run a company called Fundable Startups. I came to do what I do as a startup coach, running an academy for basically for founders to be able to upskill your founder skills. That's the most important thing is when you're raising early stage funds, many investors say they care a lot about the team. So that's what we're trying to do. I came to do what I do now because I've done 5 startups. The first 2 of them flamed out horribly, even though they were very viable. The last 3, thankfully, did get acquired, and having gone through that process, you learn what works and what doesn't work. So I'm trying to give back to people what I wish I had when I was a first-time CEO.
How amazing. How amazing. Yes, Roger.
Hi, everybody. What an honor to be here. It's my first time to Austin. I'm really impressed with the people here and the city. It's got a really great vibe about it. So I founded Bay Angels about 25 years ago. 30 years ago, I was running a public company in London, England, and discovered San Francisco on a business trip. I wasn't looking to have a job, so I started a search company called Chief People. So I spent the last 30 years building the executive and engineering teams of early stage companies, and I learned right away, companies need 3 things. Obviously, they need customers, they need people, which I can provide, but they also need capital. So I got into the angel investing group, and my hat's off for entrepreneurs because it's what's made me an accredited investor.
Thank you, Roger.
Hi, my name is Sean Flynn. My journey's pretty different than most people. I lived in China for about 5 years. I had a couple failures, but one did okay. Sold it, came back to the U.S., got involved with Bay Angels as an investment director, screening about 100 companies a month, narrowing that down to a few that we'd present to the members. Through that, I got basically, a long story short, I then got involved with taking companies from Silicon Valley to set up operations in mainland China and tech parks that Huaxia Xingfu, one of the largest privately owned land development companies, were built. They built 83 tech parks. So I would take companies from Silicon Valley over to China, set up operations, have the meetings with investors there, with governments, whoever they need to talk to get things done. And then from that, I made a lot of introductions to a lot of investment bankers here, a lot of VCs, a lot of money. And that kind of segued my path into investment banking, where right now, about 20% of what we do is helping companies raise growth capital, both debt and equity, focused on that range between 10 and 250 million. So since about 2014, 2015, more or less, been very involved with helping companies through that cycle of preparing them, getting them ready, getting them in front of investors, having the conversations.
How incredible. So now let's talk about raising capital. What does the process look like? And also, most importantly, what if I need the money now? What would you say?
Well, in terms of the process, it should not be random, and you should not Google search other companies who are like you and try to mimic them. That will usually not give you the right size because it's not a one-size-fits-all. There is a structured process. I am an engineer, so I encourage people to use a structured process to be able to figure out. It's about building a funding strategy to learn how do you determine how much money you need, when you need it, and why. And that funding strategy means you raise funds after you hit an inflection point, because then you are at a higher valuation. You want to raise at the peak of your opportunity to give you the most leverage. So you determine your inflection points: product, sales and marketing, business development, and intellectual property. You determine the cost and time required to do each of them, and you roll that up, and that tells you how much you need to raise. Do not guess. You need to look at it from a bottoms-up perspective so you have high confidence that the amount that you raise is right. The other question that you asked is, when's the right what if you raise money now? Well, that's a challenge because I would say the number one thing you need to focus on is fundability. Before you try to fundraise, make sure you're fundable. There's an old Chinese proverb: the best time to plant a tree was 10 years ago. The second best time is now. If you aren't fundable and you need money now, okay, that's a challenge. It would have been better to focus on fundability, the last year or two. However, if you do need money now, make sure you figure out your inflection points and figure out how can you get by with a small amount. And when you roll up the inflection points, it should add up to a milestone that an investor would care about. You're going to tell the investor, I need 50,000 or 100,000 or whatever the dollar amount is, and if you give me that money, this is what you will get back. I will be able to get to $10,000 monthly recurring revenue, or I will be able to close that customer who's given me a letter of intent. Make sure if you need the money now, figure out what's the smallest amount that you need to raise, because as Doug Leone, former general partner of Sequoia Capital, said, raise the least amount that you can as late as you can. But if you need the money now, figure out what that dollar amount is, and tell an investor what you've done so far to get somewhat fundable, and then what you will do with the money that they will give you.
I love that so much. It's not just about how much money I need. Rather, it's what result I can create for you. In other words, when we're having a conversation with the investor, it's really not about me. It's about the investor, what return he or she can create on that. So thank you for the insight. Roger?
So I would add to that, in terms of the process, you better have raised some friends and family money before you approach an angel group. Because if your friends and family don't believe in you and you're asking me to write a check, it's probably not going to happen. And the other thing I'd like to pass on to the group is, what do you think is the biggest mistake that most entrepreneurs, when they approach an angel investor? They haven't done their homework. You need to know who is the audience, what have they invested in the past, and not only that, what do these people do on a daily basis? We get pitched all day long, blah, 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 blah. And a guy comes into our office, we have no idea what he's going to talk about, whether he's got a medical device or a new way to slice bread or whatever. So do your research, make sure you're talking to somebody who's invested in the space that you're in, and then boil it down. You guys live with this stuff 24/7. You know every detail about it. Start out by talking about your grandmother. Honey, what is it you're working on? Well, Grandma, we're working on a new way for people to rent cars that we don't own, or whatever it is, and then get into the woods. But most of you start out, you're way into the woods. I've had 4 meetings today. I have no idea what you're talking about. I'm not an engineer, so boil it down, do your homework. And in terms of raising capital, people think, oh, it's really, really hard. It's not that hard. It's a simple process if you think about it. So find somebody who's been funded and they're in a similar space that you're in, and then call that CEO and ask them if he or she would give you an introduction to the venture firm that funded you, because in this business, there's nothing more valuable than an introduction.
I love that, Roger. And I love the point you brought up about explain our ideas simply. Today, well, not today, many, many years ago, Albert Einstein used to say, if we cannot explain our ideas simply, we simply don't understand it. So it's so important as entrepreneurs, as a founder, to tell the right vision, to tell the right story in a simple way so everyone can see the world that you see, because at the end of the day, you are just one pitch away from changing the world, and your story had the power to do that. And I love the power about the point about friends and family, because guess what? Next Thanksgiving, you're gonna see your Uncle Shell, okay? You better have a good idea and good result, otherwise you're gonna feel awkward. So in other words, if you're able to really get that money from the friends and family with, with that commitment, with that, yes, I'm gonna do this because I'm gonna see you next year Thanksgiving, as an investor, they know you're gonna hustle, and that is what they bet on. It's not at this moment your progress, your result, your revenue all in the bar, which is amazing, but this very moment, in the early stage, it's all betting on your hustle, your commitment, how you wanna serve your customers. And I love that insight so much. Thank you, Roger.
Well, I guess I'm gonna be the contrarian a little bit, and careful
Please.
which friends and families you go to. I mean, do the ones that you're borderline, I don't really mind if I don't see them again or not. Because in reality, it's more likely that's going to happen than the other. But diving deeper in the process. So it's very similar to, a structure that you might be interested in using. And I have a podcast, the Silicon Valley Podcast. I've actually interviewed everyone on the panel on that podcast. One of the people I interviewed was Nathan Beckham, the founder of Founder Suite. And we just talked about the funding process step by step by step by step. And a way you could look at it, very structured, very engineered, and this is how we do it at the investment bank I'm at, and it's very similar to an exit. So you gather all your marketing material, all your material on the company, and create a data room. That data room has everything about it: articles of incorporation, the org structure, the cap table, the financials if you have any, your pro forma, where you're going to use the money, everything you can think of, put in one central location. And then from that, you're creating your marketing materials. That marketing material could be your pitch deck, could be a blind profile, could be a sim, depending on what you're doing, the stage of your company. But think that pitch deck. You're taking the information from the data room, creating the pitch deck from it. You're seeing where your gaps are, right? You have something to reference. You're saying, okay, what information do I need? What am I missing? You're testing it out with people, having conversations, getting feedbacks, changing. While that's happening, you're also creating your investor list. Your investor list, as mentioned, do your homework. It should be the same people that would write checks for your size of company, your sector, everything. Do your homework so you're not wasting anyone's time. Yes, warm intros are fantastic, but the problem is getting a warm intro that's not relevant. So many people are so nice, and they'll go, oh, Roger, you have to meet so-and-so. Okay, Sean made the intro, I'll take that meeting. And then after that meeting, Roger calls me up, why would you make that intro? I'm like, well, the person was nice. We had a conversation, and I didn't know anyone else to introduce him to. And, you got stories, so I made the intro. But it was a waste of each person's time. Roger wouldn't invest in that type of company at that stage, that sector, and that company, is looking for angels and got nothing out of that meeting other than, a drive there, half hour, an hour, and drive back. Really target. Have that list of 100, 200 potential investors that really match up with your company. Like I said, sector, check size, geographic location. The list can go on and on. Narrow it down. Build that relationship early. Like really. There's a saying I love that hopefully here in Austin everyone gets. You feed an army for a year to use for a day. Right? You build these relationships long term so that one day when you need them, they're there for you. So start with that list and go, okay, I'm going to just have casual conversations. I'm going to ask for feedback. I'm going to create this mail and this once a month or quarterly email that tells them about the updates. That says this is what we've accomplished. This is what we need help on, an introduction here. Hey, these are thank yous for everyone that's helped us in the past. So you're building those relationships, you have that investors. Okay, then after that, now it's time to raise capital. You go out, send out your pitch deck, have the meetings, go into due diligence, step by step, get the term sheets, get the check. But really, it's process 1, 2, 3, 4, close. And if you think about that from day one and match that up with, as Sam said, those inflection points, those value inflection points on biz dev, patents, and the other items that I mentioned, line that up with your funding, the process, you're really optimizing everything. And I'd love to get more feedback on anything I missed there, but and questions later about it. But really, there is that prepare, these steps to prepare for that day. And it's not just, you need money today, we do it tomorrow. It's, no, you're doing this from day one for 6 months, 9 months, 12 months, 18 months down the line.
I love that point. Truly, it is a long journey. It's not just today I need money, tomorrow let's write a check. Oftentimes, I want to tell folks, raising capital is like a dating world. You first met a gal, a gentleman, you hopefully like him or like her. The goal is get next meeting schedule rather than tomorrow he or she say, yes, I want to marry you tomorrow right here. So I love the point so much, and thank you, Sean, for breaking down that into detailed process, step by step, so we all can visualize what the process might look like. So now we all know, right, understand the big picture about raising capital. And now my next question for all the panelists is, now think about the past 2 years we lived through the pandemic. Think about the recent economic downturn that we all heard about, right? So how does that impacting the raising capital process? What do you hear? Any advice to share with entrepreneurs?
Right. So I work with an accelerator called Berkeley Skydeck. So we've had a number of investors come into the Skydeck cohorts and talk about the fact that, yes, the market has changed. It has definitely gone down, but they are still writing checks. What it requires, though, is for companies to be fundable. Before, there is an element in the venture capital space of fear of missing out. So once one investor goes in, it's easier to get the second, third, or fourth, okay? So there's certainly that. But in today's day and age, with today's economic situations, that you can't rely on that to get you over the hump. You need to focus on building a healthy, fundable company. Those companies are absolutely still getting funded. They're getting decent valuations, okay? So I would say focus on executing well, plant and fertilize your tree, so to speak, and make sure that you are building something that somebody wants to invest in.
That's wonderful. Build a great company, and the money will always follow.
So in terms of what's happened in the last 2 years with COVID, it's actually been a blessing to my recruiting business because I've been able to recruit people from all over the country for my Silicon Valley companies, and I don't have to pay Silicon Valley wages. People are working from home. They're a lot more creative. Clients don't have to fund expensive office spaces. So I'm hoping that after COVID is gone, this becomes the new normal. In terms of investing, we're spending less money on salaries. We're spending less money on office space, et cetera. The other thing that's happening is, we just laid off 25,000 engineers into Silicon Valley. 25,000. I've been through 2 of these dot-com failures. And the first one, 2001, engineers were lined up at Starbucks just to get a job. Well, in between those 2 things, or those 2 events, engineers are like gods. They can go to 10 different companies. You got to pay them almost as much as you pay a CTO. That's not true right now, and it won't last for long, but this is a great time to start a company. It's a great time to hire people. What you're going to see is you're going to see lower valuations, and there's a tremendous amount of competition for that money. But like you said, that money's still out there. And the last thing I want to say is I want to be sure everybody understands the difference between angel investors and venture capitalists. Venture capitalists have a lot of money and they have a lot of power. But they just follow us. We write with our own checks, and it doesn't get more personal than that. You're asking me to write a check out of my pocket. That's personal. So VCs, bless their hearts, and they're a big part of the economy, but in my opinion, they are heavily armed sheep.
Wow, thank you. Sean?
I'm just looking at the reactions from the room.
Yeah, I wasn't sure what was
Because
going to happen.
I'm kind of guessing 1 or 2 people are VCs here, and But going back to what Sam was talking about plenty of dry powder there. One thing to keep in mind is VC funds, private equity funds, all this institutional money. When they raise their capital, it's to be deployed over a certain number of years, right? They have to deploy it or they give it back to their LPs. No one wants to do that because they want to use it. They want to get their management fees. They want to use the money. So when the money was raised, say 4 years ago, it got deployed, over the pandemic, people raised a ton of money. So there's a lot of money still on the sideline that's got to be deployed in the next 2 years, right? So there's plenty of opportunity for companies. Yeah, they are going to be more picky because their LPs are looking over their shoulder a little bit more, but the money's still there to be deployed. So everyone should keep that in mind when they hear things on the news of these people are getting laid off. Well, there's also that money on the sideline that needs to be deployed. Now, going to Rogers about this is a great time to start a company, to build a company. I just had a conversation with VC in Miami, and was really interested is she's starting to see all these companies that were founders at Palantir and a lot of these companies where let's not use Palantir, let's use another one that's private company that people were sitting on all these options and they were thinking, wow, these options are going to be huge one day, but they're seeing their companies, decline. And now they're going, well, staying with this company, it's not as great as it once was. The opportunity cost to leave right now isn't as high. I'm going to leave right now and start my own company. So we have that. We have engineers being laid off. We have all this money on the sideline. It's a great opportunity. And in a year, 2 years from now, we're going to see a lot of companies that were started at this time start hitting the news. So it's a great opportunity. Okay, for entrepreneurism, it's always a great opportunity because as long as there's a problem, you find a solution. That's just in your nature. But keep the news and that to the side. Figure out how to get through it. But the money is there, and there's money flooding in from overseas as well that a lot of people aren't talking about. And then there's a lot of money on the sidelines from overseas that are really waiting for that opportunity to flood to the U.S. So another thing to keep in mind.
Love that. So sum up, all the money is coming your way. So let go of all the negativities. In the new year, ready to get all the checks. So with that, I'm going to ask the next question is, what are maybe one of the blind spots that oftentimes founder has in the raising capital process?
Founders are passionate about what they do. A lot of people describe their company as their baby, and that's understandable. The one huge mistake that I see founders make when trying to pitch to an investor is they take their story that they're trying to tell a customer and they just tell that story to an investor. Okay, that's wrong, all right? You tell a product story to your customer hoping the customer will buy it. The story that you need to tell an investor is your business story. Tell enough about the product to help them understand, but the focus of the presentation should be your business. How do you tell that? How do you do that? What is your focus of the investor pitch deck? There are two things that are important in an investor pitch deck. One is what I just mentioned, the story. Make sure your story is clear, concise, understandable. Write it at the level of a children's book, okay? The second thing that I would recommend the focus is you need to de-risk. You need to show how you have de-risked the company, okay? And there are 12 different areas that I usually do when I do pitch coaching. There are 12 specific areas to focus on how to tell the story. Each one of them, there's probably about 6 or 7 of them where you have to specifically show how you have de-risked specific challenges that will usually take a company down. If you can convince an investor that you have solved these 7, 8, 9 common risk areas, then your likelihood of getting investment is very high. Do not tell a product story to an investor. Tell a business story to the investor.
Wait, Sam, tell us about one of these de-risk things. I'm curious.
Yes. What is one example?
Yeah, so one of my favorites is going to be traction. Okay, I am a data guy. For you to tell me that I'm going to conquer 1% of a $10 billion market, I'm like, I don't care. Everybody says that, okay? So what I want to know is show me how you have already given traction. Don't tell me what you're going to do. Show me what you plan to do over the 3-year period and how the last 6 months you are tracking to plan. That helps me to see. By looking back 6 months and you showing me the line is going up and to the right, I'm like, okay, you're on a good pathway here. Okay, you have potential to execute well. if you've done the last 6 months well, and this is your plan, then I have more confidence that the next 24 months might go the way that you're telling me it's going to go. So make sure, I am a big fan of the traction side. There's tons more, but there's what I would definitely say as well about the traction stuff. The trending is very important. Don't tell me you sold $100 worth of total sales. I don't care. But if you tell me you sold $10, $20, $30, and $40 the last 4 months, the numbers are going up and to the right. Okay, that's an example of showing me the trend, showing me the proof, rather than just, oh, I got $100 in total revenue. Over what, 10 years? Okay.
Great point. In the performance world, people say, show, don't tell. This is exactly that. Thank you.
So to your point, nobody believes the 1%. Nobody believes the hockey stick that we see on the revenue forecast. But what we would believe, bring me a potential customer who says, if you build this service or this product, I would use that. That would impress me. The other thing I want to say is, before you ask for money, go as far as you can with the money you've raised. I mean, 25 years ago, I remember Pets.com got like a $25 million valuation based on their URL, Pets.com, and that was it. Well, then the next thing you know, fast forward 25 years ago, at Bay Angels, we're looking at companies that have revenue that have never raised any capital at all. So I'm not saying you have to have revenue, but the whole model has changed. Show us something that you've got some traction, that you've developed a product, you've got some beta users, and then go out for money. So go as far as you can and do as much as you can with as little as possible before you ask for money. And then when you do ask for money, don't put back wages in your financial forecast. We don't care about, making you right on the $10,000 a month you should have been paying yourself as a founder. That's not where my money is going.
Thank you so much.
I totally zoned out when you asked the question.
What is the one biggest mistake or blind side a founder has when it comes to raising capital?
Those short naps are great, aren't they?
They are, really, really. Time zone difference, 2 hours. There's a lot of mistakes. I'd say overall, one of the biggest mistakes is the story itself. And why I say that is, I'll see a pitch deck, I'll talk to a founder, and the pitch deck doesn't say really much of what they've actually accomplished or done. But then after an hour conversation, it's, oh my gosh, there's so much more to this that you weren't able to tell. And even when they're telling the story, I have to ask question after question to really get that information from them. And it's amazing how, I'll sit down with the founder and they'll go, yeah, my team, we've known each other for years, is great. And then I'll look and go, wait, your team, the history of it, I mean, that person was pretty high up at these companies, and wait, they've had 2 exits, and why didn't you mention any of this stuff? Oh, I didn't think it was a big deal. Like, no, that's a huge deal. That, going back to Sam, that's de-risking this company. And okay, tell me about the traction. Oh, we've had sales. Oh, for who? Wait, what are those contracts like? What, they're for this long, this many years over? That's amazing. Why aren't you mentioning that you've got these purchase orders for? Oh, I don't know. And it's crazy how much, and this goes back to create that data room with everything. When you're talking to people, there's what's happening and then what they're saying, and some people are a little bit too modest, others brag a little bit too much, but there's that nice little spot in there where you're telling the story, telling everything in a concise way that's getting that message across, that really resonates with the person across from you at the table. I mean, whoever is sitting across, adjust the story for that person, be adaptable, listen to the words they're using, listen to the questions they're asking, because that person across from you might really want to focus down on certain metrics, right? The person across from you might really want to focus down on the team. That person across from you, build that rapport, listen, and then respond. And I think that's huge. And it goes back to sales, goes back to a lot of things, but listening to, I guess more than anything, I guess just not be nervous in a conversation, just be open to communicating and listening and adjusting to it. I think that's huge.
Yeah. If you can get revenue, brag about the revenue, no doubt about that. But what do you do if you don't have a revenue yet? Okay. So you look at the life cycle of a company. You launch, then you work on a product. Once that product is built, you work on selling it. Then after you sell it, you get revenue. So there are multiple individual phases. If you're pre-product, how can you raise money? You need to focus on validation. Tell me how you've built up a backlog of customers who said, if you build it, I will buy it, all right? Focus on validation. That's one of the reasons why I bought a company called Venture Validator, okay? Because it was a professional services company that specialized in that. Validation is key. Okay, so if you've already built your product, what do you do if you haven't gotten sales yet? You're post-product, but you're pre-sales. Talk to me about your pipeline, okay? You should have a sales pipeline, a funnel that shows from the top of the funnel all the way down to the bottom. You may not have gotten a customer all the way through just yet. Show me how big the pipeline is. Show me how hard it was. How much money did you spend to get somebody in at the top of the pipeline? Then how much time, money, and effort did it take to get them from that stage to the next stage below, to the next stage below? Show me real data, real numbers. And then if you are post-revenue, then show me unit economics, okay? At that point, you can show stuff like customer acquisition cost, et cetera. Until you have a customer, you don't know what the customer acquisition cost is. Show me those numbers, and then I can make a more informed decision about whether this company has any potential and whether I should write a check or not.
Love it. Show us the money. Before we dive into the last question, get your questions ready, okay? Because we're going to come to you as a real-time question to all the amazing, brilliant people. All right, so the last question before we do so is, now they are empowered with all the knowledge, all the insight. Now they got to go after for that check. What is the one last piece of wisdom you want to partner with?
So it's kind of hard to pick one, all right? There's lots of people out there who have lots of suggestions on how to be able to raise capital. There's a lot of information. I'm going to try to pick something that people don't usually talk about, and that is when you're putting together your pitch deck, make sure you are very clear on your writing, okay? This is almost never talked about. I have seen people put 500 words on a slide, and I'm like, oh my God, I can't read that. Besides the fact that I'm older and my eyes aren't that good, okay? You need to make your slide glanceable, okay? An investor might get dozens of pitch decks a day. If they even choose to look at it, they're gonna spend a minute, 2 minutes, 3 minutes. So your slides need to be glanceable. And by glanceable, that means very, very few words. So in order to write very tight copy, you need to make sure you know how to write. Very few people talk about this, but if you do it, then your slides will stand out and be differentiated from the other 10 or 20 decks that an investor is gonna get that day.
Be short, be sweet, and be gone.
I'll bet there's at least one person in this room who's overwhelmed by the process. They've got a great idea. They just moved here. Let's say they just moved here from Canada. They've got no network. They don't have any connections. They've got a great idea, but they don't know where to start. Well, volunteer and join an angel network, or work on a committee like this. There are at least 4 people in this room that used to be interns with Bay Angels. It's a great way to get into the network, meet some great people, talk to other entrepreneurs, bounce your idea off the angel investors and the other people that belong to the group. Again, it's not that hard. And back to what you said about spelling on the deck, I've had people make mistakes on their own resume. And if you can't get your own resume straight or your own deck straight, that's a deal breaker to begin with. So pay attention.
Thank you.
All right, I'd say one thing that, well, even going back to the mistakes that people make for advice, is do due diligence on the person you're meeting, right? Know what that person likes, what that person focuses on, find out who they've invested in the past, make sure everything aligns up. Really go into that meeting with the questions you want to ask them, with what you want to get out of that meeting. Ask in advance, okay, before the end of this meeting, I'm going to ask what the next steps are. Do they have to go to their investment committee? Do I have a meeting with so-and-so next? What are the next steps? And know that, okay, if you really liked what I presented and you're thinking about it because you didn't say no, will you make introductions to other investors you like to co-invest with? Yes or no? No? Well, that means you probably didn't actually like it. Yes? Great. I mean, have these questions in advance for those meetings that you have. utilize every moment. That would be my going away note.
I'd like to add one thing to that. Silicon Valley is a very small neighborhood. Everybody knows everybody. So if you do a bad pitch at one group, that's probably going to be the last meeting you get. If you do a great pitch, then doors will open. So keep that in mind. And we refer deals back and forth to other groups. We refer good information. We refer bad information.
Yeah, and as a practical tip, Sean talked about doing your due diligence on the investor. Okay. The investor will probably have a web page, and they'll have all these company logos of companies they've invested in. Reach out to the CEO of the companies that they brag about that they invested in. See if it's, any of them will respond back to you. Of course, get a story about whether how it was working with the investor. Then ask that CEO, do you know anybody else that this investor has invested in? See if that person, because they usually know someone, and if that CEO tells you a name of another company and it's not on the investor list, then contact that guy with all the effort that you can, because that's going to be a situation where the investor maybe not be proud of. You need to find out what happened, okay? So every investor is going to go, the test of a good investor-founder relationship is not when things are going good, it's when things are going bad. The test of a good marriage is not when you just got back from your honeymoon, it's when your kids are driving you crazy, your spouse is like ignoring you, or whatever the case. It's those times where you need to evaluate what is that marriage built on. Same thing with a founder-investor relationship, okay? They're gonna have all these logos of companies that are successful. See if you can find a company that maybe wasn't that successful, and how did that investor handle that relationship.
Brilliant. Pick the right people, because he or she going to be with you for a long haul. So with that, ladies and gentlemen, your moment have finally arrived. That means you now get to ask tough questions to the smart people on the panel. So who had the first question? Yes, sir.
No, I have a real loud voice.
Brian, let's get the mic anyway.
Oh, yes, okay, that's fine. Yeah, I lived in San Francisco for 20 years. I got a real loud voice, but I live here for the last 10. My name is Dennis Menendez. I am the oldest person in the room, except for my dad sitting over there. I work with international startups. I have 4 from Australia, India, Sweden, and Argentina. I speak Spanish fluently. And I also have one that I'm working with in cooperation here in the U.S., and you should meet these guys. But the thing is that I'm noticing, and what I don't see in the American early stage startup, is there isn't enough involvement in terms of government. Most of our startups in Australia, Sweden, India, Argentina, even Argentina, which is 90% inflation, they get funding from government, from trade associations, from universities. They build, and they're really interested in having a competitive edge in the world by building innovation. And I like what you said, which was disruption is the soil for innovation. And I thought about how that's really important here. We have all this disruption. That means we got a lot of good soil. But I don't see that kind of seeding that needs to get done. And it's really tough on the investors unless you're going after these people coming in from other countries who have a lot more started up.
That's a brilliant insight. What's your question, sir?
So the question is, when you go and work with startup companies, do you look at yourselves as an investor, or do you look at yourself as a person who's going to build a package of investments, which includes public as well as private monies?
And the takers.
All right, I'll start that. So I actually think there are a lot of resources here from universities. I mean, Sam works at Skydeck, which is at UC Berkeley. I'm an advisor at the SBDC, Small Business Development Center in San Jose. Brian, a lot of people here have some connection with universities, whether they're an adjunct professor or an advisor. There's a lot of resources out there from universities, accelerators, SBIR grants. The list goes on and on. Yes, overseas there might be a ton more. I mean, Korea, their government matches any investment that angels will make. Canada has an amazing program for engineers. China, when I was helping companies go there, it would be, I mean, some of these tech parks would be, okay, you don't pay taxes for 2 years, here's a building for you, and tell us how many PhDs you want. I mean, literally, it was just, here, anything you want, it's there. But the question is, do these companies actually scale in the real world? Once they get all these, the assistance from the governments out of the way, business in reality into new markets, how do they fare? And we'll get a lot of companies from Korea and these other countries that had so much assistance from the governments there, and then they enter the US and they kind of don't know how to do it on their own. They don't know how to adapt their product for product market fit in the new environment. They don't know rules and regulations. They don't really know how to network, because back where they're from, maybe networking was take this person to dinner and drinks and go to karaoke, and next thing you know, your company's fine. So it's a completely different environment in some areas. I do think that there are a lot of resources for companies, but they do have to leverage. I mean, right now, equity, or for a long time, equity was so cheap in Silicon Valley. You wanted to raise capital, talk to these people. Now they are looking at more, debt, more SBR grants, more other components. Now they're looking at overseas investors, sovereign wealth funds, these family offices. Jason here is the managing director for an incubator from Dubai that just set up operations in Silicon Valley. So there's money flooding in from overseas that people are tapping into. So I guess what I'm trying to say is there are a lot of resources depending on where you find it easier to go to. Some it is the private sector, some it is the public, but having those conversations and the network, maybe falling back on that. If you have the network, you're made aware of these. You do have to go out and search for them, find them. If you're just sitting at an incubator that's focused on this, that's all you're going to hear about. An accelerator, all you're going to hear about. But if you have that big network and ask around and ask questions, then you're going to start hearing stuff. And this also goes to why second-time founders or third-time founders are more successful, because they have the networks, they have the resources, they've had the conversations. They have all these people they can leverage that are experts, advisors that can weigh in and really guide them to where they can go and untap all these resources that, you'll talk to some of these groups and there's tens of millions of dollars just sitting there, and they go, well, no one's even tried to access it. And you're like, oh, well, that's the government for you. But, so the resources are there, getting the knowledge, the network to get there, that's the challenge that a lot of, I'd say, companies struggle with, is just it's too overwhelming. A lot of companies coming out of universities, they have great ideas, but they don't have a network yet. A lot of companies coming that are PhD founded, amazing ideas, no network, no business connections, which are so valuable, and the network is so needed. So,
What I might say is that I can't speak for international governments, but what I have seen when I've worked with startups from Austria and a couple other places is that they actually work on building a business. They have revenue, okay, before they actually try to fundraise. Here in the US, that's less the case. Now, when things were hot and frothy back in 2019, 2020, you could have lots of users, and that would be enough for you to raise money. Now in 2022, we're going back, the pendulum is swinging back. Are you a business, okay? So a lot of what I kind of say is, my mantra is focus on fundability before you fundraise. I am, I guess, more of a traditional value investor. I don't know how to pick the next Facebook. It's almost like buying lottery tickets, okay? Yeah. So I don't know how to do that on a consistent basis. Yeah. So I can't just pick the right lottery numbers. But if I'm going to gamble, I can maybe learn how to card count on the blackjack table. And I'm going to look at those types of things where I can improve my odds. If you can demonstrate that you have built a viable business, then I'm more interested than just hockey stick growth up and to the right. My first startup I was at, I was not a founder there. We basically stomped on the gas pedal with both feet because we were told to do so. That if we booked $1 million in revenue, the investment bankers would take us public. So we raised $55 million, and we booked $1 million in revenue. Okay, the investment bankers were all over the office. You could tell because they dressed better than all the other employees. Okay, and then the .com market crashed, and the investment bankers said, "Oh gosh, we missed the window." All right, but it's not just about cranking out users, revenue at the expense of profitability. I'm more of a value person. If you can demonstrate that, your company prints money, then I'm more interested in it.
Well said. Who has a next question? Yes, sir. You and you. You go first. We are running. All right.
First of all, thank you for your time. Question, on the run up to either an angel or a VC, what are some mistakes that you could make in the friends and family round in terms of structure or dealing with the aunts and uncles? Are there like best practices there or things that you absolutely do not want to do? Thank you.
Yeah.
Great question.
Yeah, so one of the classes in my academy is how to raise money from founders, friends, and family. So Sean already talked about the social aspects. Be very careful of that. To me, the relationship is more important than the money. All right. So keep that in mind next time you're at Thanksgiving dinner, et cetera. That would be one thing. Another thing that a lot of founders do when they're selling capital, or excuse me, selling equity to their friends and family, is they will just say, well, for whatever, $500,000, I'll give you 10% of the company, or whatever the math turns out to be. And then they start issuing common stock. Generally, you don't want to sell common stock because there's some tax challenges, and it also results in premature inflation of your common stock share price. If you are a traditional venture fund, you're going down the traditional venture funding path, and if you inflate the common stock share price, then your stock option pool, the strike price, will be inflated as well, and then the upside for your employees will be diminished, and it'll be much harder for you to hire employees. The other thing to be careful of is you're selling to a family member, be careful of using a convertible note. Convertible notes have opportunity to give someone leverage over sharper elbows. Okay, when you're playing basketball, you get elbowed in the head. Okay, I tend to favor, if you're doing fundraising from friends and family, I lean towards a safe. Okay.
Brilliant. Last question over there.
Oh.
Just last question. Yes.
Thank you guys so much for all the information so far. My name is Grant Hansen. I'm launching a startup here locally, which the problem we're solving is forging new high-level career pathways for ex-convicts and formerly incarcerated individuals. And so my question is really a two-part question. One, in terms of when you're talking to founders, when you're talking to them, is there a preference that you guys have between ones who have found a way to bootstrap on the front end versus seeking pre-seed funding? Does it matter to you guys? And if so, if you see people who are seeking pre-seed funding, but you see a potential way for them to bootstrap on the front end instead, do you ever consult or maybe show them how to do that?
Yeah, for me, I always love seeing people who are scrappy, okay, and figuring out how to make something out of very little. That matters, versus just saying, give me money, give me money, give me money. Money is not going to solve most people's problems, okay? As a case in point, you guys remember Quibi? Or I don't remember the name. Yeah, they had an old TV company. They raised 1.8 billion, over $1 billion of cash, all right, with some of the biggest names in Silicon Valley and Hollywood. They died. If you think money can solve the problem, I think Quibi would disagree with that. So I love the scrappiness. If you can show me what you've done with very little, then I'm like, okay, this founder shows me one side of execution that at least going well. That's starting to show me you've de-risked a portion of your message to me.
Good for you and your group for turning your life around. Big hands for that.
Just to add to that, actually, I'd like to piggyback on Dan's real quick, and then if that's, do we have enough time? 2 minutes? 3 minutes?
Yes.
So Dan, one of the big problems that people I see mess up at the beginning when they start their company is how they allocate equity to the founders. Some people go, okay, you're 50%, I'm 50%, let's go. And you're like, wait a second, that all vested on day one, and then 3 weeks later, that person's like, yeah, my wife says I can't do this anymore. I got to go back to get a real job. And you're like, wait a second, but you have 50% of the company. What's going on here? So a lot of people on day one, how they allocate equity, how it's vested, how they carve out that cap table, that can really basically destroy the company. I mean, honestly, I have conversations in advance because a lot of people don't realize that going back, and I'll use the term that Sam keeps saying, if you do that wrong, you're no longer a fundable company. I mean, really, you're not. And during break, we can talk horror stories. So that's one thing. For the other, if you can bootstrap, it's incredible when someone approaches an investor and says, listen, with this little money, I was able to recruit these people for my team. We've accomplished these milestones. We were able to have these conversations. And you're like, wait a second. You're able to get these people to quit a job that was paying them $200,000 a year to come work for you for nothing. You were able to sit down with these people. You were able to get these sales with nothing. Like, that's incredible. I mean, it shows so much of you, the founder, or the founders, the team, your sales strategy, your business savviness, just everything. So, and we can go in for days for that too.
Thank you so much for the insight. Wow. And thank you so much for all of your questions. And happy networking, everybody.
All right, big thanks to our panelists and our moderator. We're going to take a 10-minute break, and then we'll be back to talk about how to scale your company. Now, in this last panel, we heard a lot about also what bucket do your conversations go into when you're talking to somebody. I'd like to offer you a free resource. Every Thursday at 12 p.m. Pacific Standard Time, join heroicvoice.com/Jim. It's office hours on what those conversations and those pitches look like.